The RBA has lifted the cash rate by 25 points. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of coffee, we're going to have a talk about the RBA lifting their cash rate by just 25 points. So they're now, and I'll bring up the chart here, we're now sitting at 2.6% as the target for the cash rate. You can see that climb. We haven't had rates this high in quite some time, everyone. Now, this is lower than, well, everyone expected, or the majority of people expected. If we jump over to the other screen here, we can see on trading economics, the consensus was 2.85 and the TEF, trading economics forecast, was 2.85 as well. So a 50-point increase when they've only just increased by 25 points. You can still see that steep climb up there. And a few days ago, I put a poll to the viewers asking you what you thought rates would be. So how high will the RBA hike the cash rate on the 4th? 2% said actually decreasing it by 0.25. 1% said zero, no move. 11% got it right at 25 basis points, 0.25. 62% thought it would be 0.5%. And 23% thought it would be higher. So you can see here, 11% were on the money. It shows you, consensus isn't a sign of what's going to happen. That goes as well with economists and some of these polls we see. So let's have a look at the statement here by Philip Lowe to see what he has to say and why he's, raised lower than expectations. Is it because, maybe the market's overheating a little? Or it's it'll be okay. We'll have to see because they're not keeping up with the Fed in the States. At its meeting today, the board decided to increase the cash rate target by 25 basis points to 2.6%. It also increased the interest on exchange settlement balances by 25 basis points to 2.5%. The board is committed to returning inflation to the 2 to 3% range over time. Today's increase in interest rates will help achieve this goal, and further increases are likely to be required over the period ahead. The cash rate has been increased substantially in a short period of time. Reflecting this, the board decided to increase the cash rate by 25 basis points this month as it assesses the outlook for inflation and economic growth in Australia. So rather than not making any change and waiting to see, they only made, a smallish change. As is the case in most countries, inflation in Australia is too high. Global factors explain much of this high inflation. Yeah, that's true. Shipping costs are through the roof. There are a whole lot of issues beyond the control of the Reserve Bank here in Australia. So, how much impact is this going to have? Strong domestic demand relative to the ability of the economy to meet that demand is also playing a role. Now remember when, I'm going to bring this up again to show you, I need to update the text down the bottom here. But remember when we were told the cash rate wouldn't increase until 2024. Now that hasn't materialized, has it? The issue is some people believed that. And they borrowed on that basis. So now reality is coming home. A further increase in inflation is expected, hang on, I'll zoom in a bit more, is expected over the months ahead before inflation then declines back to the 2 to 3% range. The expected moderation in inflation next year reflects the ongoing resolution of global supply side problems, recent declines in some commodity prices, and the impact of rising interest rates. Medium-term inflation expectations remain well anchored, and it is important that this remains the case. The bank's central forecast is for CPI inflation to be around 7.75% over 2022, a little above 4% over 2023, and around 3% over 2024. The Australian economy is continuing to grow solidly, and national income is being boosted by a record level of the terms of trade. The labour market is very tight, and many firms are having difficulty hiring workers. The unemployment rate in August was 3.5%, around the lowest rate in almost 50 years. Job vacancies and job ads are both at very high levels, suggesting a further decline in the unemployment rate over the months ahead. Beyond that, some increase in the unemployment rate is expected as economic growth slows. Wages growth is continuing to pick up from the low rates of recent years, although it remains lower than in any other advanced economies where inflation is higher. Given the tight labour market and the upstream price pressures, the board will continue to pay close attention to both the evolution of labour costs and the price-setting behaviour of firms in the period ahead. Price stability is a prerequisite for a strong economy and a sustained period of full employment. Given this, the board's priority is to return inflation to the 2 to 3% range over time. It is seeking to do this while keeping the economy on an even keel. The path to achieving this balance is a narrow one, and it is clouded in uncertainty. I mean, that's probably the most accurate thing he could ever say. There's so much uncertainty out there. You've got to remember, economies are emergent systems, and they've only got so many things that they can intervene on. They don't even try to. When they're saying who's the better economic manager, it's kind of bullshit. It's kind of who is slightly steering the ship that's going in its own direction. You can slightly adjust where its path is a little bit if it wants to. I don't think management is the term. One source of uncertainty is the outlook for the global economy, which has deteriorated recently. Another is how household spending in Australia responds to the tighter financial conditions. Higher inflation and higher interest rates are putting pressure on household budgets, with the full effects of higher interest rates yet to be felt in mortgage payments. Consumer confidence has also fallen, and housing prices are declining after the earlier larger increases. Working in the other direction, people are finding jobs, gaining more hours of work, and receiving higher wages. Many households have also built up large financial buffers, and the savings rate still remains higher than it was before the pandemic. Come on, guys, just go out there and spend a bit so he won't raise the rates. Come on, quick, just for a month. If we all work together, someone start a Facebook group. They did it for Reddit and the meme stocks. Wouldn't that be funny? Trying to twig the data that the RBA uses. Today's further increase in interest rates will help achieve a more sustainable balance of demand and supply in the Australian economy. This is necessary to bring inflation back down. The board expects to increase interest rates further over the period ahead. It is closely monitoring the global economy, household spending, and wage and price setting behaviour. The size and timing of future interest rate increases will continue to be determined by the incoming data and the board's assessment of the outlook for inflation and the labour market. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that. They will do what is necessary to achieve that. That's an interesting line. Let's have a bit of a talk about that one. So that's something we have to keep in mind. The board will do what is necessary to achieve inflation at their target between 2 and 3%. Not that they've actually managed to get it there and hold it there for any significant length of time in recent memory, but I'm sure now they can. I mean, how much of it is actually in their control? They're going to impact a lot of the discretionary spending by people who have mortgages, and we won't even see the real effect of that until everyone who's locked in and who's locked in their mortgages start to flip onto real rates. How many of us have locked in with low rates because we didn't trust Philip Lowe? I'm not going to encounter higher rates until 2024, other viewers until 2025. Progressively, more and more people are going to, those rates are going to disappear, some this year, some next year. So you'll start to slowly see the impact of increasing rates on more and more mortgages. I encourage people to prepare for that, to do the sums and check out how much your mortgage repayments are going to increase, probably 30 to 50% in some circumstances. And even now, just start taking that money and putting it in a separate account every month, and that's your return to reality fund. And see if you can do it for 3 months and test. Just test. See how your budget's going. For most people, it'll be no issue at all. You're probably already doing that. You're probably building up a war chest for tougher times. That's why the savings rate is so high, perhaps. For others, particularly those who borrowed recently, who don't know any different, who got FOMO'd in, it may be a bit of a wake-up call. You've got time to prepare. Okay, you've got time to prepare. So run that scenario now. Test it out now so you know what's going to happen. I think most of the viewers of the channel, judging by the demo, majority of you won't be in that situation, but some people will. And now that's what you got to do. So we'll have to see, guys. They're going to raise rates as high as they need. At least they're slowing down a bit. And most of us were off. Only 11% got it. Congratulations. A razor shine to you. Take care, guys. And I want to remind you to check out my other channels, HeiseBim and HeiseSays International, for other content I create. And if you're a fan and want to support us, there are a few ways you can. Financially on YouTube or Patreon, using our referral links on Amazon, eBay, Independent Reserve or AussieBroadband, buying our pocket squares, we still have a few left, or calling us if you need an architect. Take care, everyone. Have a great day. I'll see you in the next episode. Bye for now. I had a $2 coffee at 7-Eleven today. It hurt. Inflation's here.